Hey, what's going on, guys? Today we're going to be talking about our active investment strategy compared to typical investment advice you would get from a CFP or other financial advisor that takes a commonly used passive indexing approach where you primarily just own everything in the market, and that's the way to do it, basically. When we were creating or throughout the process of creating this active strategy, I know you were the one primarily doing the due diligence, but one, maybe even we should go back further than that, for sure. Coming to Bitcoin changes your perspective on investing in many, many ways. So, first and foremost, that changed our perspective. But then we also still took a kind of passive approach to investing overall, still, even after becoming Bitcoiners and understanding how Bitcoin can really change the investment landscape. But now that we have this active strategy that we've rolled out with clients, I think it has further changed how we view these old mantras maybe thrown out by financial planners. And we know them very well because we used to say the same things to clients. We used to believe those things ourselves. And we've come to change our opinion on many of these items or many of these things that you guys listening have probably heard, whether it's on social media or it's from your financial planner or financial advisor specifically. And so we just want to dive in, share these mantras or these common investing principles, maybe you could say, and our argument against them, why we believe those aren't actually correct. And so I think this is going to be a lot of hot takes, if you will, at least in the financial planning space. Yeah, let's go ahead and dive in.
Sounds good.
All right. So the first one, this was something that I actually saw recently from a financial planner on Twitter. I won't mention them, but they were talking about Bitcoin specifically, and they said many people don't need it to reach their goals. So let's just first let's take Bitcoin out of this and let's just address what they're saying. Essentially, they are saying they don't need higher returns to reach their goals. That's what they are effectively saying. And so, because they don't need higher returns to reach the goals that they have, we are choosing a portfolio that will likely not produce those returns, or those better outcomes, if you want to phrase it that way. So let's just let's nail this one first. What are the problems you see with an advisor saying that to their clients?
Yeah. I mean, first and foremost, I was thinking about this earlier today, actually. Not in this context, but it works well. Um, there's kind of this input output mindset when it comes to investments. So, what I mean by that is, we have an input of how we allocate money for clients or recommend they do that. And then the output is, okay, we do that because it does X, Y, Z, whatever, right? And I think that financial planners have become, uh, in general, broad strokes, not everybody, have become too focused on the inputs and less focused on the outputs, right? I mean, most financial advisors would tell you no, like no, we do goals based planning, all this other sort of stuff. But at the end of the day, they're doing that still within the context of their already kind of preconceived notions around portfolio design. And so they're just saying, all right, these are the inputs that we have, and that's that, right? Like they're this is what we're going with, and okay, yeah, they can reach your outputs, right? And to this point, then really what we're getting to, or what I'm getting to, is like, well, yeah, if you constrain inputs, so if we constrain inputs and say, well, yep, these are the portfolios we have, they return X% per year, whatever, so yep, you can reach your goals at whatever age or whatever goal you have, whatever amount it is. um,
Mm.
we're not doing our full fiduciary duty. If we have something where we have an ability to change those inputs and say, hey, I know these are your goals, I know you want to retire at 65, but
Mm.
what if we can do it at 60 instead, right? And yeah, maybe that means changing the allocation, and maybe that means, yeah, part of the allocation, at least for uh, normal advisors, maybe is seen as more risky per se, which that's a whole nother can of worms that we may or may not get into. But uh, if they they kind of have that mantra, well, no, we can't do it because it's more risky. Well, it's like, well, first let's talk about risk, but outside of that, the second component is, well, is it really though? Like, is it really more risky? And when it comes specifically with Bitcoin, sure, Bitcoin, highly volatile asset, which most people, volatility and risk are one and the same. But when we can constrain and kind of put parameters around a Bitcoin allocation and fit it into a holistic portfolio, and almost across the board within a reasonable allocation at least, what you have is an enhanced returns with really no or minimal volatility increase. Then it's like, okay, well, that gets to be compelling. And again, this part of this does get back to this idea that people just don't understand Bitcoin, and they're putting Bitcoin in the same bucket as, well, I'm going to own a whole bunch of Tesla stock, or I'm going to own a whole bunch of Apple stock or whatever. And it's not. Bitcoin is not a different asset. It's a different asset class. It's a completely new asset class that we haven't had historically, until it
Yeah.
was created however many years ago. So yeah, when they say, yeah, they don't need Bitcoin or whatever, well, all you're doing is really just relying on your laurels and saying, well, these are the inputs we've designed in our portfolio construction. And I'm sure you've got good reasons for why you've designed them that way. Everybody, for the most part, does. But that doesn't mean they're the only ones. And that doesn't mean that we shouldn't look at the inputs as well as, I mean, and I should say, as equals with the outputs, right? Like we don't just want to say, well, yeah, the inputs as it sits now can reach your goals, so we're good. No,
Hmm.
that doesn't fly. Like at the end of the day, if we're here to make clients money, right? Like most advisors are not going to be doing their jobs if they're not making their clients money across time. Um,
Hmm.
then we do have some duty to that. Obviously, we have to do that within reason. We can't just, YOLO into, yeah, single stocks or meme coins or whatever else. Like it's not all returns based, of course. Um, but that doesn't mean, again, we can just kind of say, yep, this is what we have. There we go. So to me, that's the fundamental thing here. So it's like, okay,
Hmm.
you don't need, that risky asset based on what, right? Well, my client can reach their goals. Okay, do you tell your client, hey, we can do things differently, we can do things more, we can do things more quickly? Are these conversations that you're really having, or are you just refusing to have them? And most of them are, because again, they just fundamentally don't understand what Bitcoin is and what it represents.
Yeah. No, I 100% agree with that. Of course, it's almost like you have the opportunity to do better, but you choose not to do better. Why? Why? That
Mhm.
client hired you to do better than what they can do on their own, and you, even, let's just exclude Bitcoin maybe from the conversation, and let's say we're just considering an investment universe of stocks and commodities and bonds, traditional assets that have been invested in for many decades. If your advisor is telling you, okay, well, you don't need 100% equity allocation to reach your goals, you can do it on a 70-30 based on historical returns or whatever it may be. It's like, well, why would we do a 70-30 when we could maybe retire, like you're saying, 5 years earlier with 100% equity allocation? Why?
Mhm.
It's like where you just automatically exclude something that could be better off for the clients just because they don't need it. I don't know. I don't understand that. It's like that person could be spending more time with their grandkids. They could maybe get that second home on the beach or whatever that they really wanted. They could give to their church or charity, or they could, do whatever, have more impact, have more generational wealth at the end of the day. It's like advisors or financial planners these days have completely ignored the value add opportunities of actually making a client more money. It's like, oh, we will help you save money on taxes or save money by avoiding big mistakes, or we'll help you by planning. We'll kind of, like you're saying, we'll take your inputs and we'll connect that to the outputs that you want. But it's like if we could significantly improve the outcomes that we can achieve based on our knowledge that we should have, we are advising people on their money. We should have that knowledge to be able to improve the outcomes, not just listen to what they want and help them get to wherever they want. They have this idea in their mind that could be significantly different or better based on them choosing to hire us. And that's where, for us coming up with this and crafting this active investment strategy, it's like, well, let's kind of zoom out for a second. Let's disconnect from that entirely and let's just talk about what's possible. What is possible? Let's dream a little bit. Let's open this, back up to, we're actually going to help you have a significantly better outcome in retirement or whatever it is based on our unique understanding and investment knowledge, which I think most financial planners have just completely given up on these days with the rise of passive investing.
Yeah, because you don't have unique knowledge or understanding anymore. You have a herd mentality, and it's kind of a twofold thing, right? We have a herd mentality within the industry itself because there's career risk in doing something besides passive investing now, and then furthermore, we have a compliance and regulatory environment that can heavily penalize that as well. So you have an incentive to not do that because it's like, hey, if somehow that doesn't work out, okay, that's going to reflect poorly on you and could literally cost you business, not only with clients leaving but regulatory or compliance actions. And and again, it's not that all regulation is bad or all compliance is bad. Like at the end of the day, yeah, we are held to a fiduciary standard and we need to be I guess held to that. Like that is good that we are held to that. But at the end of the day,
Mm-hmm.
fiduciary, what's that mean? That means that we're, doing the best we know how to do and we can do for our clients, right? We are acting in their best interest on their behalf. And so, when you have a just kind of mantra that, well, that's passive investing and, don't necessarily look anywhere else. It's just, we're constraining our inputs because why? Well, because okay, passive is what you do, and to be quite frank, passive is really easy, right? Like it's
Mm.
very easy just to say, okay, hey, I'm going to put together a passive portfolio. Okay, that portfolio goes down on here. Well, that's just what the indexes did. Yep. No, okay, that's what it is. Like we get to take no responsibility because we say we have a hands-off approach. Now, passive in and of itself, like every portfolio is an active portfolio. It's just a matter of how active is it, right? Like if and unless you literally even this like this is about the least passive you can get. You set an allocation and you never change it and you never rebalance it. That is as passive as you can get. There's still active decisions in that and how we get that initial allocation. How do we determine what that appropriate initial allocation is? But furthermore, when we go to more of a regular kind of passive strategy, yeah, they're updating those allocations, every quarter, every year, every couple years, whatever it is. They're probably rebalancing every quarter, every year, something like that. These are all active decisions we're making. And now, again, those active decisions we're making are backed by a lot of historical data that says they're good ones to be making. A rebalanced portfolio tends to outperform a non-rebalanced portfolio on a risk-adjusted basis over time, but the same premise applies. Like we're trying to remove, right, because now it's like, well, why would anybody work with us when they can just go and passive invest themselves? So okay, maybe we get some edge because yeah, we're doing 5% to small cap value, or we're doing an international tilt that's a little bit more or a little bit less, whatever. um, but at the end of the day, what we're really trying to do there is minimize our career risk, because why would we take that risk, when we don't need to? Again, this gets back to this need, right? I don't need risky investments. Or my client doesn't need risky investments. And it's like, question about risk, whatever, but that
Yeah,
need
yeah,
again,
totally.
who is saying that's the need, right? Again,
Mm-hmm.
because we are fiduciaries and we have to act in our client's best interest, then okay, there, client does drive things, right? They're always in the driver's seat. As we kind of say, you're the CEO, we're the CFO, right? We make recommendations to the CEO, and you get the final say so on whatever happens or doesn't happen. But at the end of the day, we are still being paid for our expertise, whether there is expertise there or there's not expertise. And
Mm-hmm.
because of the rise in passive investing, it has allowed a lot of people who don't necessarily have expertise to just, basically Okay, it doesn't matter. They can actually even offload that expertise and just say, okay, yeah, this managed portfolio from BlackRock, sure, yeah, we'll just trust their allocations instead of making any decisions on our own. This is why so much of
Yeah.
a financial advising has gone to financial planning now, right? So
Mhm.
financial advisor, investment manager, that's kind of, it's there's still a lot of our industry that's like that. Don't get me wrong, but the guys that are doing it right for the most part, they're also doing financial planning. So we're not just looking at investments, we're looking at cash flow and risk and estate, items, all this, taxes, whatever else.
Mhm.
But part of the reason that we had to do that is because, yeah, people understand that if you're just doing something that I can just do otherwise, then why would I pay you to do that, right?
Yeah.
And again, like
Yeah.
there's a whole can of worms there with the behavioral finance side where, yeah, I mean, it's shown time and time again that people who work with advisors do outperform those who don't on average because there is that
Mhm.
behavioral bias where we can step in and say, we are unemotional in our decision making, or at least less emotional than what you
Mhm.
are when you're making these decisions with your own money. um, and so there is value in that in and of itself, but again, it's kind of
Yeah.
like it's been taken to this extreme for some of those reasons I laid out, whether it's just the career risk, whether that's the regulatory environment, whether that's just, hey, being in the crowd is better than being out of the crowd, whatever. Again, like most of the people that have these mindsets, they are trying to do the best they can for their clients, and most of the time they are doing a really good job. But that's not the point of what we're talking about. The point of what we're talking about is that just because you're trying your best doesn't mean it actually is the best. And so
Mhm.
that's where we get to, yeah, that's why we've created
Yeah.
things that are really trying to go and say, hey, we have knowledge and expertise that you don't have. So let's use that and utilize that to make better outcomes for you. So to tie this back in, like, okay, you don't need a Bitcoin or risky investment, whatever. Like, okay, maybe you don't. Maybe you truly don't need it. Okay, fine. Then in that case, it still doesn't negate the need or the possibility of holding riskier investments. Because then what
Mhm.
you can just have is you can have, let's say, more of a barbell portfolio, right? Okay, so yeah, we've got risky investments over here, but we also have a 30% cash allocation. Hey, actually, a lot of people might like that to know that they've got 30% of their portfolio in cash instead of being 100% invested in the markets and having that exposure. Again, like we're not changing the risk profile really, like depending on the portfolio, we're not changing the risk profile, the volatility, or anything else, but we're just saying, well, we've got performative assets that we can use to still grow the portfolio while still having a cash buffer for, hey, those just in case scenarios, right? Like
Mhm.
that's a good outcome too. And that again is what, when we talk about inputs outputs, we're saying, well, we're not even going to consider that input, because why would we want to consider that input? No, we're going to fully invest money because, again, like we kind of have to, because that's what you're paying us for. You're paying us to manage your money, and if we're just holding it in cash and then not really doing anything else with it, or we're just throwing it in an index and so we're just truly underperforming, that's a bad outcome for people.
Yeah, absolutely. I mean, it feels like a lot of CFPs have completely given up on investing altogether.
Hmm.
And not investing like we're not investing in the in something, but they've given up on actually trying to manage investments in a better way than just holding the S&P 500, or okay, we're going to hold all index funds basically, um, in these various allocations, whatever. And you can see that because a common phrase thrown out, or at least a variation of this phrase, is the value of a financial planner lies outside of investment management. It's like, oh, we just completely ignore, don't pay attention to the investment management side of things. Look at over here at the planning and the taxes and the estate and all of this that stuff, which is very valuable, but that doesn't come at just, okay, we discard this side of things when it can have such a massive impact. I mean, this strategy that we keep referring to, by the way, if you go back to our previous video, you'll see the performance numbers, on the strategy that we've built. And it's a similar downside experience, similar, I won't say volatile experience, but overall it's a very similar experience to 100% equity allocation in the S&P 500. However, it's like a 13% compounded annual growth rate on the S&P 500 versus 31 or something like that on our strategy. And of course, there's all the caveats and disclaimers there. So go watch that video. I can put those in this one as well. But the point is that is a significantly different outcome. And then we pair that with tax planning, estate planning. We pair that with the financial planning stuff too. It's incredible. It's incredible what outcomes that we can provide. And so when I hear people say that the value in hiring a financial planner is not in the investment management piece, it's uh, like, have you just completely given up on that, or what? Like, I don't understand that. And I used to say the same thing, to be honest. Like, I used to say these same things, but it just always didn't sit right with me in the back of my mind. I told you this recently as well. It just never quite sat right with me, but I didn't understand or have a strategy in place to be able to say, like, no, here is actually something better. And actually, through doing the research on first on Bitcoin, which completely changed my understanding of our financial system, I think that's really where it foundationally has to start. And maybe we can get back to, maybe that's why these CFPs are, doing what they're doing on the investment side, is because they really don't understand how money works. They don't really understand what money is. They don't understand our financial system as much as they want to say that they do. They really don't. And so I think it starts there, but then it trickles down. And so starting there and then coming up with this active strategy, it's like my eyes have been completely open to, like, why would we ever do that when we can achieve way better outcomes with what we have created for our clients? So, yeah, I don't know. I
I
don't get
think,
it. I guess I
well,
do get it because I used to be there, but now I don't.
there is something important in this too. Like, I guess there's two important points to me is I know we're kind of wrapping on passive investing here, and rightfully so, but that doesn't mean that passive investing does not have a place in a portfolio. Like, having holdings that are very tax efficient that we never change is probably always going to have a place in the portfolio. That can it makes sense for a lot of people and for a lot of cases. But it's just this, oh, we only do that. That's the only thing that we're doing. That's where it becomes problematic. And for all the reasons that we just laid out. And I think the second thing to this, you kind of brought this up, like, why do people think this way? Why, even in the industry, why do we think this way? And it really is based on all of these, for example, the famous Buffett experiment, right? He went out and said, hey, hedge fund managers, I'll bet you that you can't outperform the S&P over the next 10 years. And this was like, I think it was pre-Great Financial Crisis to post-Great Financial Crisis. I can't remember the exact years, but it doesn't matter. Basically, S&P won over the time frame versus hedge fund managers, which, again, it's like, well, hedge fund, what are they doing? They're not always necessarily going for total performance. There's other things that hedge funds are doing, right? Whether that's downside risks, whether that's just alternative exposure, whatever. But besides that point, that whole ingrained mindset of active management bad, that's part of where it comes from, right? The other part of where it comes from is all these studies that are, have shown that active managers underperform their benchmarks, especially the longer term you get, right? It's like you go back and you look at these studies and it's like, yeah, okay, 5% of active managers outperform their benchmarks over 20 years or 30 years or whatever. And it's true. That is right. But the underlying premise there is what's wrong. And the underlying premise is that, yeah, they're tying back to a benchmark, right? Again, inputs, outputs. Like, what are we getting at here? Well, the input that we are doing is, okay, we have a fund that is going to hold most of the same things that the S&P 500 is, or same companies, but we're going to do it in a different weighting or different methodology or whatever it's going to be. And then, yeah, we're going to try to outperform the S&P 500 over that time frame. Well, a couple of things with this. One, yeah, that probably is going to be really hard to do over very long time frames. But two, again, to this premise, like, not all active funds are trying to outperform. Maybe they're trying to get 75% of the S&P 500 with 25% of the, drawdown. that the S&P 500 has. Yeah, they're never going to outperform. Well, I shouldn't say never, but they're hardly ever going to outperform the S&P in that environment unless it's a down year, right? And so this is where it gets to be okay. When
Yeah.
we look at those things, what are we really seeing? Well, we're seeing, yeah, they're being held to some sort of standard to say, okay, yeah, they're not outperforming. What we're not doing, we're looking at a specific investment. What we're not doing is looking at a holistic portfolio. When we zoom out and look at a holistic portfolio and say, okay, yeah, maybe we have active parts of a portfolio, or maybe it's even passive parts of a portfolio. What I'm getting to here is underperformance by active managers of a fund does not necessarily mean that active asset allocation strategies also follow the same mantra, right? It doesn't mean that those are the same. No, they're two
Mm.
completely different beasts, really, right? Because, like in our example, we're not choosing stocks. We're not picking and choosing yet individual stocks back and forth. We're allocating into different parts of the market, and that allocation is very broad. Where yeah, we can allocate to stocks, we can allocate to commodities, we can allocate to bonds, we can allocate to Bitcoin, we can hold cash. It is a portfolio level strategy, not a fund level strategy, which is what all of these things are based on. And again,
Mm.
in partly because of the rise of passive investing, that's again where okay, you get less active managers even wanting to be involved in trying to do this stuff anyways, because it is hard to beat an index if you're trying to just use the same mix of companies over time. And
Yeah.
furthermore, because of the mindset of the modern investor, and because a lot of our historical industry, it really was like, yeah, we'll beat the benchmark and we'll charge you, 2.5% along the way. And they never did, but they got their 2.5%. Like there is, that wasn't necessarily great outcomes for people either. Like there is that aspect. But man, it's just like they're just two different beasts,
Mhm.
right? And again, this is where I get back to this whole we're always making active decisions in a portfolio the way we design it. No matter if that's, extreme active type strategy or the most hands-off, completely passive active strategy where we're making a
Mhm.
single allocation and never touching it. We're
Yeah.
still making active decisions in that. It's just to what level are we doing that? And what we're, really saying here is that, hey, like we see value in doing more of that. And there's good reasons and actually good data to support that as well at a portfolio level, not
Mhm.
necessarily an individual fund type level. So try to,
Mhm.
sorry, got off course there, but you said that. So I had to
Yeah.
open that can of worms.
Yeah. Well, I think I hear what you're saying, and I hope that everyone listening does too. But I think there's a flip side to this that often does get thrown out by these advisors of you know our benchmark, or we're not trying to beat the S&P 500. Like that's not our benchmark, basically. So we shouldn't ever compare our portfolio to the S&P 500. But then what that is ultimately them trying to get out of is that their investment performance is consistently worse than the S&P 500. And so it's like, well, there's a balancing act here of saying, yeah, we shouldn't be compared to benchmarks, but again, if we could get a better outcome because of our better knowledge and understanding of investing, better methodology like you're saying, it's like, well, why wouldn't we, at the end of the day? And so, there's certain situations where, yes, we should look at the benchmark and understand, where the, differences are between your investment strategy and whatnot. And there are times when you shouldn't, just like you're saying. So I think that because that's a common one that I'm sure a lot of clients have heard from their advisor is, well, we're not trying to beat the S&P 500, so you shouldn't compare our portfolio to it. And it's like, well, over a long enough time period, we probably should be looking at their portfolio compared to the S&P 500 and be like, hey, you know, something's got to change here. And I think a lot of clients, maybe I'm wrong, but I feel like there's a lot of clients that probably have that same doubt in the back of their mind that I still had even as the advisor myself in the early days without much experience. I had this doubt too that I just don't know if that's the right way to look at this and the right way to go about this. And so if that's you listening and you have this kind of doubt in the back of your head of like, I don't know if they're actually leading me in the right down the right path here. It's worth exploring other opinions, other strategies, other options. I think we probably have
Beat a dead horse.
beat that horse though. So yeah, we'll go on to some other ones here that are typically
Actually,
thrown
I'd
out. So
say, I know you have an order here, but I think our third point is really where we should go next. And the reason being is because I can hear every advisor hearing everything we say. And then this next point is going to be the big but of all of this. And that's just this
sure.
whole investing should be based on risk tolerance, right? Um, so what is risk tolerance, right? Like there's tools in our industry that can try and inform us of what risk tolerance is, right? You go through an exercise with a client, you say, okay, your portfolio is $500,000. Here's two options. You can be up 80% or down 20%. What do you choose? Okay, now you're up 30% or you're down 20%. What do you choose? Like, there's these tools that can help try and educate this whole risk tolerance discussion. But um, by and large, I think they're useless. And I don't even think that. I think there's actually data that proves that out. I would have to go back and check on that. But what I'm getting at here is, I think the advisor, they hear everything we're saying and they're like, yeah, but, even still, like, okay, you can get better outcomes or whatever, but the investor, they can't handle it. Our client can't handle it. They don't have the risk tolerance to handle it. Right. And again, it's like, okay, so maybe we have some way to measure risk. How good or not that is, maybe a different discussion. But the base premise of, okay, what is actually risk though, is still what we need to question, right? Because most people, I guess maybe there's two prevailing views of risk. One is volatility, and the other is downside. Many people will say they're kind of hand in hand, but they're not necessarily the same thing. And even outside of that, I would say that we have a third way of looking at risk too, not to the exclusion of those first two, but that's the traditional way: volatility and downside, right? The reason being volatility is just literally how bumpy your portfolio is as it's growing, hopefully. Downside being, okay, no matter how bumpy it was, at some point, you're going to have peaks and troughs. How low are those troughs? And so, it could be really, really bumpy and have really, really low troughs, or not bumpy at all and have, minimal troughs, or really, really bumpy and minimal troughs, or, any combination you can think of. And like, yeah, for sure, there's some element of risk with that, right? Like that people are going to perceive, right? Like people need to hold through bear markets. People need to hold through, big drawdowns, and that's Bitcoin or otherwise. Like, I mean, go back to the financial crisis. Stocks are down 50+%, right? Like volatility is not exclusive to just these new age assets. Like, maybe it's not as volatile, or maybe they're not as volatile now, at least in modern times, the last 10 years. Um, but at the same time, that's still there. The thing I think we add to that is that, well, but there's also, and I think this is what we were talking about above, is there's also the risk of, again, the output. Like we're focused on these kind of inputs and kind of
Well,
forgetting about the outputs.
maybe before we move on to your next point, it's like, what is the client's risk tolerance based on fundamentally? It's based on their understanding of investing or their prior experiences with money and investing. It's like, okay, if you had someone who their parents lost everything in 2008, they're probably going to be, less risk tolerant, if you want to put all the quotations on that. But it's, again, that is based on a lack of understanding of of investing in general. And so how do we allow the client then, who is an uneducated emotional investor, because it's their money, it's not our money, so they are, naturally going to be more emotional than we are, simply because it is theirs, it's their future on the line, etc. But they don't know anything about it. I won't say anything. That's not a good way, good phrase to, or word to use. They don't know or shouldn't know as much about investing as we do. And so now we are putting the limitations of what the portfolio can look like onto their understanding of investing. And it's like, that makes no sense. They're hiring you to invest for them. why are you crafting the portfolio solely based on what their risk tolerance is?
Yeah.
That just makes absolutely no sense to me.
It's like going to the doctor and you're sick or whatever. The doctor says, "Hey, we need to do this." And when I say sick, I mean like, I don't know, cancer or something like bad, not just like a common cold type thing, I guess. So you go to the doctor and they say, "Yeah, we need to have chemo or do whatever, this other stuff is." And I'm not going to go down that rabbit hole because I know we have our views, but just the idea then that, okay, yes, the client, they're ultimately in control, right? They ultimately get to say so. But at the end of the day, a cancer doctor knows more about cancer than what the cancer patient does. So we're not going to let the cancer patient direct in full the treatment. I shouldn't say direct. We're not going to let them be the sole input authority of the cancer treatment plan, right? Like,
Mm-hmm.
sure, the doctor might say, okay, you have some options, right? Like, we can do chemo, we could do, and I don't know what they all are, but like, here's 3 different treatment plan options. But at the
Yep.
end of the day, like, we're not just letting the client say, well, I saw, if I just go lay in the sun all day long and I drink lemon water, that should be good enough. Like, okay, maybe like it might work out, sure, but like again, we're going to push back on that. We are the authority, we are the expert with it, and again, this is where it gets to this whole. To me, this is more where the compliance and regulatory stuff comes in, is that our industry has basically nerfed what we as advisors can really feel comfortable in doing, because it seems like so often when people go outside of the box, that okay, that's where our risk comes in, is okay, we're going outside the box and doing something maybe a little bit different than what everybody else is doing, and now all of a sudden the regulators
Mm-hmm.
are saying, yeah, no, you can't do this, of course, without knowing our clients. It's like the insurance companies saying that no, you can't treat your patient the way you want to treat it. It's nonsense in some way, right? It's not a perfect example there because that insurance to
Sure.
medical relationship is different,
Yeah.
but that is still there too. It's just
Mm-hmm.
like this whole idea that, yeah, okay, of course, client always has say, it's their money, right? Where we are contracted by them to do the best that we can. But yeah, that doesn't relieve us from being the professionals and being the experts and giving our expert opinion
Yeah.
and doing the work required for that, right?
Mm-hmm. Mm-hmm.
And by work, I mean like, okay, our knowledge, making sure that we know what we're doing, that we understand things in a way that, yeah, is more complete than what the average individual investor is going to understand across time.
Yeah. No, absolutely. I love that analogy. That's a great way to put it for sure. Um, I think there's also, like you're saying, that definition of risk is very skewed
Hmm.
in financial from financial planning perspective. It's always viewed as, like you said, volatility, or this max drawdown, which is like, sure, okay, maybe, but there's a flip side to risk, and that is okay. We our portfolio or our wealth is not actually outgrowing the growth of the money supply or inflation, and so effectively we are becoming poorer over time because we have chosen to have a client-led allocation that is maybe what 60/40, I don't know, and it has 4% returns a year. And and then you benchmark that and compare it to the CPI, and you're like, oh yeah, we're still growing our wealth, which is actually not true. And so there's a flip side to risk that I don't think gets acknowledged by financial planners very often, because again, it's the safe thing to do to put money in bonds. It's the safe thing to do to put money in treasuries, and take these kind of in the box approaches like you're saying. And then when we add on top of that a client, led investment strategy that doesn't have an understanding of investing, it's like we end up with this very quote unquote conservative approach that is actually risky to the other side. Um, and I would I would also venture to throw in risk there of not actually reaching the goals that we have, or the maybe the goals or outcomes that we could achieve. It may be that their goal is to retire at 65, but what if you could reasonably achieve retirement at 55 with a better strategy? That's a risk in my mind. of like, okay, if we didn't do that, we didn't achieve the best possible outcome that we could reasonably achieve. Again, we're not saying go put money on black at the casino, or go buy a lottery ticket every single day and hopefully that you make it. You make it. It's like it's still a very reasonable approach to investing that can just get significantly better outcomes. And so the risk that, okay, I missed out on 10 years of retirement with my family, with my wife, with whatever, or working on a more fulfilling, project or job or whatever it may be. I think that's also a risk in my mind that doesn't get acknowledged.
And it's a risk to us advisors too. Many advisors won't admit it, but just because it's so far down the road, but you know, especially in our in the moment world, short term world, whatever. Everybody's got a short time preference, right? Um,
Mm-hmm.
in our modern world, everybody is concerned about the now. But it's like if I'm a financial advisor and I'm trying to do the best I can for my clients, if I'm not actually maintaining their purchasing power across time, am I really doing that, right? And again, this is a risk, like maybe a client won't even realize it over the long term, right? Like they're going to see their portfolio going up in dollar terms, they'll be happy, right? But if your portfolio is going up 6% a year and money supply is growing at 8% a year, congratulations on your 2% paycheck cut every year, client, right? And again, that's where Bitcoin can be so helpful in really kind of understanding some of this base level stuff that a lot of advisors don't, because they just, they don't, right? Like they don't want to look into it or haven't looked into it or whatever else. Like,
Mm-hmm.
I think that's the difference where we come from, is that we do have a different lens, to your point that you started with, that we view the world or view the investing world because of what we understand about Bitcoin. And that means that, yeah, there is other, to our point, risks outside of just volatility and downside risk, right? Um, and that's not to
Mm-hmm.
say we don't care about that stuff. Um, we do, right? Because at the end of the day, like, yeah, it doesn't matter what an outcome might be in 30 years if you can't stomach the 6 month drawdown that is going to happen on a portfolio. Then yeah, like that's a bad outcome still.
Mm-hmm.
But it is still just to this point of, okay, but if we're doing, if we have a way, which we believe we do, if we have a way to continue to grow purchasing power across time in real money supply adjusted dollars, we feel we have a fiduciary duty to do that, right? Even if that
with
means
with less drawdown, with
true,
less downside. Like that I think is important. You got to add that second part in there
yeah,
of like, if there is a strategy to where we actually have less drawdown, we may have a little bit more volatility, like you're saying, bumpiness, within those bounds, if you will, but it's ultimately a less drawdown than just having the S&P 500. Most people would probably view the S&P 500 as not a risky investment.
hmm.
Advisors would say that, financial planners would say that, but I think most people would not view that as a risky investment.
Yeah,
And
because
then,
most
okay,
people know the S&P 500 is the de facto savings account of the American household now. Like even if they don't like literally know that, they know in the back of their minds somewhere
yeah,
that is true, and it is
uh-huh.
true, right? Like, I
Yeah, with
mean,
the infinite amount of cash at the Federal Reserve,
yeah,
it's okay.
yeah, right. Even though what's that chart? Going back to like what the Great Financial Crisis, the S&P, when you adjust for monetary supply, hasn't reached new highs since then, or some crazy stat, or like the 50s or something like that. Like it's just it's nuts, right? It's like, yeah, well,
Yeah,
that's why that gets into the whole can of worms we're not going to go into, but the fact that everybody has to be an investor and we have to do this stuff, right? Like
yeah,
that's the crappy part at the end of the day. Like it'd be really nice if we didn't even have to think about this or talk about this, except for people that wanted to, get excess returns because they are an investor, right? Like
yeah,
this whole
yeah.
idea that we should still be able to save. But anyways,
Right.
I digress.
Yeah, that's a different conversation for sure. But yeah, I think with what you're saying, what you brought up of, okay, the risk tolerance thing and the client not be willing to accept or be willing or able to hold through a really sharp drawdown or extended bear market. But when you have a strategy like we have developed, where at least historically it has significantly outperformed the S&P 500 with a very similar downside experience, well, okay, what's your argument then? You know what I mean? It's like, why would you not choose the better outcome with, because we're not capped by the client's, risk tolerance again, quote unquote. Um, and so,
And most
yeah,
people, for our strategy specifically, will say, well, yeah, you did that, and you're also including, early stage Bitcoin. Like nothing says that Bitcoin's going to do that in the future. That's a valid, right? Like, yeah,
sure.
past results don't mean, or whatever, historical results doesn't mean that's going to happen in the future for sure.
Uh-huh.
But at the end of the day, with Bitcoin where it's at now, I mean, I think that argument is a little bit easier in the previous Bitcoin cycles, where you have, like no institutional adoption, no real kind of, it's still kind of the Wild West. It's still very much the Wild West, the space, but even more so then. But now, we literally have nation states buying it. Corporations that are actually, in some of these indexes you hold, have they are also holding this. We have ETFs that hold this, right? This idea that financial advisors can just kind of continue to keep sticking their head in the sand about this is getting less and less realistic by the day, right? And so it's
Hmm.
at the very least you have to
Yeah.
be educated around it. And if you're educated and you still don't want to make the decision to allocate to that, okay, that's fine. But to just completely ignore it because you think it's a tulip mania, um, you fundamentally don't understand Bitcoin for one. But for two, like you're getting
Yeah.
proven wrong as we speak, right? No matter yeah, okay, Bitcoin's got its 25% drawdown again today, and everybody's saying it's dead or over probably. But no matter what that shows, like
Sure.
the fact of the
Sure.
matter is, like, yeah, it's a new asset, but it's not that new, right? You have 14
Yeah.
years of price history, at least that we can
Hmm.
rely on here, and rely just meaning we have it. And to just say you'll ignore it, because whatever, like yeah, that's getting a little bit less feasible.
Yeah.
And so that's kind of the beauty of what we're doing is we can see at least an eventual future, the writing on the wall with what Bitcoin can represent. And it's like,
Hmm.
yeah, you don't need to be a hardcore Bitcoiner to take advantage of what Bitcoin can represent as far as price appreciation. When you have a
Yeah.
finite asset and on one side and an infinite asset on the other side, and the infinite asset is the one that everything's denominated in. Okay,
Yep.
well, that base base logic you can see an eventuality. Doesn't mean it's going to happen, but
Yeah.
we can at least see, hey, if things continue to play out,
Hmm.
this could be an eventual possibility at least. And again, that's
Hmm.
what a lot of investing comes back to is we have to understand what's possible first, and then okay, work backwards from that. Again, inputs,
Hmm.
outputs. People are starting on the input side and forgetting about the output side, and what's possible is on the output side. So, all right,
Yeah.
let's start there first, and then work our way back.
Right. Yeah. And, even if that is you know, pushback against our strategy, for example, by a client or someone in the industry or whatever, it's like, okay, let's look at the numbers with a 5% Bitcoin allocation, a 2% Bitcoin allocation, a 1% Bitcoin allocation. It's like, all right, fine. It'll still work out because again, if you haven't watched the video before this, go watch it and you'll understand what we're talking about. But we crafted these sleeves to outperform their benchmarks, and so okay, if we just even if it was 100% equities, it has outperformed the S&P 500 over our backtest analysis. And so it's like, well, whatever. If you want to drop the Bitcoin allocation because you're so worried about it being Bitcoin dependent, the performance at least, well, okay, let's just keep it included in a small, tiny, percent allocation, and it'll still do its thing. There's plenty of if you just run a backtest analysis. I think it was like I don't know, 98% cash, 2% Bitcoin, and it still outperforms the S&P 500 over the past, I don't know, like 10 years or something like that. And so when you add an active strategy that already outperforms the S&P 500 on top of a small Bitcoin percentage allocation, it only makes the outcomes better. And so, we don't need to necessarily address those arguments against it because most of our clients, understand all of our clients understand Bitcoin already. But when we're speaking to the CFP arguments, we're the folks that could be listening to this that are like, they're curious about Bitcoin, or maybe they do own some. They just haven't shared it with their CFP yet because their CFP was against it and recommended they shouldn't do it. It's worth looking at for sure. So, yeah, I guess let's transition then, unless you want to add anything onto that. Transition to maybe some of these other ones to wrap up here.
Go for it. Which one do you want to go
Cool.
for?
Yeah, so I think there's really two primary ones that are worth mentioning. First, just own everything. This is kind of the passive indexing approach of most financial planners right now. Is we're just going to own everything. We're going to own the entire U.S. stock market. We're going to own international equities. We're going to own emerging market equities. We're going to own the entire equities market across the world. Maybe even throw in some bond allocation in there as well. Whatever. But even then, that's owning the entire bond market usually. From their perspective. And so the premise and why we don't agree with this is that you are effectively always going to hold winners and losers by definition. By when you choose to own everything, you will consistently underperform. Let's say even just the S&P 500, as the benchmark. And why is that the case? Because you will have international that will have a season of underperformance like we've seen for the past 10 plus years. And even, international comes back and outperforms the S&P 500. Well, great. You now have an underperforming asset in the S&P 500. And so your portfolio by definition will consistently underperform because you've just decided that I don't know what I should own. And so let's just own it all and go from there.
Yeah. It's like if you're out fishing, and I know this isn't, you can't actually do this, but if you could literally take a net, spread it out across the entire ocean, and then just drag it across, it's like, all right, I know I'll get something along the way. Like, I know there's fish in here, but like, if you really wanted or you really needed salmon, like, okay, you might have some salmon, but you're probably not going to have as many, as you could have if you would have went specifically to, the spots where they are. Right now, we'll just be fine with whatever we got. Well, in this example, maybe your client really needed salmon. Like maybe they're allergic to every other fish except for salmon, and they can't eat other meat for some reason. Like, again, it's like,
Well, I think another way to put that is you're admitting that you don't know how to fish for salmon.
yeah, exactly. Yeah, that's a good way of thinking it.
You
Yeah.
know? And
Uh-huh.
so the clients hired you. Hey, I would like you to go fish me out some salmon. You don't
Mhm.
know how to fish for salmon, so you just go try to catch everything.
Yeah. Yeah.
That's effectively what we're saying here. With
Yeah.
let's just own everything because we don't know how to invest in a
Mhm.
way that actually leads to a better outcome than just owning everything.
Yeah. Yeah, and I mean, like at some more deep fundamental level, what this really gets to is this kind of, because part of how we get to this, well, we're really broad basket, we just kind of hold a little bit of everything, and then we get diversification, whatever. Well, for one, are you really getting diversification? Because when you look at correlations to the S&P to a portfolio that has both U.S. and international and has everything else, like you're still going to have a crazy high correlation, and that crazy high correlation, all it really does for you is, well, I shouldn't say the correlation itself, but you're going to have that correlation itself, and you're going to have worse results, right? Worse results in total performance. Maybe you're getting some volatility or drawdown differences. But even that, it's minimal, right?
Yeah.
And so, okay, we're getting diversification. No, you're not. Like you're just owning a basket to own a basket, right? And again, that's not. I'm not arguing that we should be ultra concentrated. No, that's not what I'm saying. But I'm just saying, like, yes, that diversification works when you actually have diversification, right? Which is why our strategy actually has it. We have, 4 different asset classes that we can include in the actually 5 if you include cash, that you can include in the portfolio to gain that diversification, right?
Yeah.
And so, yeah, we have uncorrelated returns or fairly uncorrelated returns. But it's like, no,
Hmm.
oh, I'm just getting diversification by doing this. It's like, no, yeah, well, if you're still, at a zero point 0.9 correlation to the S&P 500, like, I don't know how much diversification that's getting. And again,
Yeah.
back to this, like, well, we're just doing it because that's what, we should do. It's like, well, maybe. And, some of this, I suppose, gets back to like, efficient market hypothesis type stuff where it's just like, yeah, all information is priced in, stocks always are trading at fair value, over time, things are going to return to the mean, all that sort of stuff. So yeah, US will outperform sometimes, but then international won't. And even if that last part's true, that we have this return to the mean type idea over time, why then would we still want to hold the assets that are below I guess below for a long period of time the mean, in the hopes that, okay, we'll just hold them for that eventual when they come up? Like, I mean, there's, momentum and trend following is, like a perfect fit for this sort of thing or that sort of environment. Actually, like, if we actually truly believe things are going to return to the mean across time, then okay, let's
Yeah.
use a strategy that takes advantage of that. When assets are
Hmm.
outperforming above their mean and they're continuing to outperform, yeah, we'll hold those. If that starts to go the other way and the assets that are below their mean are now starting to perform, okay, we can rotate into those. Okay, that makes a ton of sense to do that. But just to own it, just because, it's like, I don't know, just
Yeah.
doesn't, I don't know, just doesn't make sense.
Yeah. No, I totally agree. Most financial planners' definition of diversification, or in practice, what their diversification is a complete facade. It really is. And so all it leads to is the same downside performance with less upside performance. That's what we've seen. We have compared our portfolio strategy to, okay, we had someone come in who's had an advisor at Vanguard. And so, they have a 70-30, 70% US equities, 30% international equities. Okay, great. That led to, I don't know, 3% underperformance on an annual basis with the same exact downside and volatility experience as just holding the S&P 500. It's like, okay, great. What did you do there? You did effectively just gave your client worse, worse outcomes because you don't know how to fish for salmon.
Yep.
So
Salmon's the best
yeah.
fish, as everybody knoes. So, I mean,
Right.
really just a disappointment because salmon's
Uh-huh.
delicious. But
Totally.
yeah, it just,
Totally.
I don't know. Yeah, the whole own everything, like, again, like, I'm not even saying it can't be part of the portfolio. Like, again, like, we want to talk about, actual diversification. Diversify your strategies. Have stuff that's going to do that, right? That's going to have, okay, I'm going to passively hold every single stock and every single publicly traded market across the entire world. All right, enjoy your 20,000 stocks or however many there are. I don't know. But it's like, yeah,
Yeah.
again, it's not like you have to just, okay, we're just doing away with that. Like, no, sure, like, passive is still going to work sometimes, but again, it's just this exclusivity piece where it's like, but that doesn't mean that's all we want to do. If we can have a strategy that acts differently than what that is going to act, and then we can rebalance those strategies together, okay, now we've got hopefully another form of actual diversification, right? And not just faux diversification that we're just saying, okay, because we, yeah, own 20,000 different stocks that we're diversified. Sure, like, you own 20,000 different eggs, but it's all from the same hen. So, okay.
Yeah, 100%. And that's where, when you get to understand the actual financial system and how it works, that's what everything is downstream from that at the end of the day. So, um, anyways, I think we've done a good job of addressing these, common phrases or perspectives thrown out by financial planners today. And when we really just boil it down, it's not to say that, okay, you're doing a bad job necessarily by investing with a financial planner who's taking this type of approach. You could be doing a much worse job, for sure. But when you could be doing a better job with a reasonable, I would say the same reasonable likelihood of the outcome actually happening. It's not like we're, again, going and buying meme coins or telling you to show up and buy your lottery tickets every day, and you're gonna get this. If you have the same likelihood of the outcome happening, of success, if you will, but we have a better strategy, then why wouldn't you take it? Basically, so
I think another way to frame that is, okay, if you have, go back to this cancer example. If you have cancer, do you really want to go to the doctor that went to Colorado State Tech Online University and got C's through his whole entire doctorate, or do you want do you want the doctor that went to Johns Hopkins and had straight A's and had whatever, right? And like, I'm not trying to sound arrogant with this. I'm not trying to say we're smart and everybody else is stupid. What I'm trying to get at is, like, you're paying a financial advisor for professional and expert advice. Like, so, and I get maybe a lot of financial planners want to say, well, our expert advice is in a broader domain than just investments. Okay, fine. But at the end of the day, that still is almost I mean, almost every financial advisor is still going to have that aspect. And so just to say, well, we're not going to look at that. To have the cancer surgeon that's like, yeah, well, we're not going to consider, natural medicine along with chemotherapy. Like, okay, we're just going to look at our one, way of doing things. It's like, why would you pay for that? Why would you want to do that? And the reality is here is that it's just like, well, there's so many people that need this help. Like, it's people have to go somewhere. Like, it's still, to your point, it's still better than if you did it on your own, right? But it's like, if
mhm,
it's a good, better, best scale, it's like,
mhm.
why not get the best advice you can from a true expert, a true domain expert, versus good advice that is still going to help you and still going to probably help you reach your goals better than what you could do yourself. It's like, why would you not choose to do that at the end of the day? And this isn't exclusive to us. There's this is across domains, across expertises. Like, it's not just even exclusive to financial planning. It's still the same premise here. It's like,
Mhm.
what is the quality of what you're paying for? And it's just that I guess that's what this gets to, is it's just like, a lot of these things, it just comes from, well, this was what I was taught in my CFP book, or this is, what I was taught by, learning this industry myself. And, this is the main way of thinking. And so this is just how we're going to do things. I'm like, all right, yeah, that's probably going to lead to good results. But, again, fiduciary duty. We have to do what's best for our clients, not what's goodest, like what's best. Those are two different things.
Yeah, yeah. Not what's just okay. Not what's acceptable, maybe
Yes.
is a better way to put it. So, anyways, yeah, for sure. All right, well, let's go ahead and wrap it up here. If you haven't already, go watch the previous video to this one, where we really lay out the investment strategy that we've created and we believe is a great fit for a lot of folks. Of course, we don't know your situation, we don't know you, so we can't say that without actually talking to you. So reach out to us if you have interest in how we may be able to help, and we can talk more specifically about your situation, your portfolio, etc. And then we can actually give you, specific advice that we cannot give on, this podcast here, because we don't know who's listening at the end of the day. So none of this was meant for any advice, recommendations, nothing like that. This is not financial advice. This is for informational purposes only. And reach out to us if you want to talk in a further fashion. But appreciate you listening all the way through. And at the end of the day, we believe that we are just simply trying to do what's best for our clients and leading to those better outcomes, that we can help them achieve above and beyond just taking a more passive approach, to investing in general. So we'll see you in the next one.